Imagine walking through the financial district of one of the world's richest cities. The skyscrapers still stand, the elevators still work, the lights still turn on. Nothing appears broken. Yet beneath those buildings, billions of dollars are quietly losing value. Not because the concrete disappeared, not because the steel weakened, but because the system surrounding the buildings changed. Most people think real estate is about property. Architects know it is about cash flow. An office tower is not valuable because it is tall. It is valuable because people are willing to pay to use it. Remove the tenants, and something remarkable happens. The building remains. The value begins disappearing. And because commercial real estate sits at the intersection of banks, investors, cities, and businesses, that disappearing value can ripple through the entire economy. Today, we decode the hidden time bomb beneath modern commercial real estate.
Commercial real estate is often misunderstood. People see buildings. The system sees infrastructure. Every office tower represents thousands of relationships. Businesses lease space. Banks finance construction. Insurance companies manage risk. Pension funds invest capital. Cities collect taxes. Employees generate economic activity. Restaurants serve office workers. Transit systems move commuters. One building supports an entire ecosystem. Its value extends far beyond its walls. The building becomes collateral. Collateral supports loans. Loans finance businesses. Businesses employ workers. Workers generate income. Income fuels consumption. The architecture becomes deeply interconnected. This is why commercial real estate occupies such an important position inside modern financial systems. It is not simply property. It is a platform connecting multiple layers of the economy.
For decades, the system appeared remarkably stable. Businesses rented offices, employees commuted, leases renewed, property values increased, banks extended financing. Then, one assumption changed. Work no longer required the same physical location. Digital infrastructure reduced dependence on centralized offices. Video meetings replaced conference rooms. Cloud platforms replaced filing cabinets. Hybrid work became normalized. Suddenly, demand shifted, not because office buildings became obsolete, but because businesses began asking a new question. How much space do we actually need? That question changed incentives. Lower demand increased vacancies. Vacancies reduced rental income. Lower rental income reduced property values. The buildings did not fail. The assumptions behind them did. And whenever assumptions change, architectures must adapt.
Commercial real estate is rarely purchased entirely with cash. Debt plays a central role. Developers borrow. Owners refinance. Banks lend. Investors expect predictable income. Everything functions as long as cash flow remains stable. But rising interest rates introduce a new challenge. Old loans mature. New financing becomes more expensive. Property income may no longer support the larger interest burden. Some owners refinance. Others cannot. Asset values fall. Collateral weakens. Banks reassess risk. Credit becomes tighter. Notice what happened. The crisis did not begin with empty buildings. It began with changing financing conditions. Because leverage amplifies outcomes. When values rise, debt accelerates returns. When values fall, the same leverage accelerates losses. The architecture that once created prosperity now magnifies instability.
Why does commercial real estate matter so much to banks? Because buildings often secure enormous loans. Collateral creates confidence. If borrowers cannot repay,
Banks rely on asset values. But what happens when collateral itself declines? Risk calculations change. Lending standards tighten. Capital becomes more cautious. The effects spread beyond real estate. Businesses seeking expansion face stricter financing. Entrepreneurs encounter reduced credit availability. Investment slows. Economic momentum weakens. This is how localized problems become systemic pressures, not because every loan fails, but because uncertainty changes incentives throughout the financial system. Banks are not merely evaluating buildings, they are evaluating confidence, and confidence influences every future lending decision.
The phrase commercial real estate crisis creates a misleading image. People imagine collapsing buildings. The real danger is something far less visible: interconnection. Modern economies function through networks. Property connects to banking. Banking connects to credit. Credit connects to business investment. Business investment connects to employment. Employment connects to consumption. Everything reinforces everything else. The commercial building simply happens to sit near the center of one important network. If that network weakens, the consequences travel outward. The greatest systemic risks rarely originate from spectacular failures. They emerge from slow structural adjustments. Lower occupancy, lower valuations, higher refinancing costs, reduced lending, slower investment. One layer influences another, until eventually the architecture itself begins changing.
The lesson of commercial real estate is not about predicting a property crash. It is about understanding systems. Most people see buildings. The architect sees cash flow. Most people see vacancies. The architect sees changing incentives. Most people see property prices. The architect sees capital allocation. Because buildings themselves rarely determine economic outcomes, the financial relationships surrounding those buildings do. Every major asset class exists inside a larger architecture. Real estate depends on credit. Credit depends on confidence. Confidence depends on expectations. And expectations shape the future long before visible events appear. The question is never, will commercial real estate survive? Cities will continue evolving. Businesses will continue adapting. The better question is, what new architecture is replacing the old one? Because every structural shift redistributes opportunity. Those who remain attached to yesterday's assumptions often struggle. Those who understand tomorrow's incentives begin building within the next system. Most people study skylines. The architect studies the invisible flows beneath them. Because wealth is never created by concrete alone. It is created by the systems that allow capital, people, and productivity to move through it. This is Nexera, Decoding Systems, Architecting Wealth.